Ladies and gentlemen, welcome to this in-depth discussion on one of the most pressing economic challenges India is facing right now. The Indian rupee has sunk to a record low, trading at nearly 88.5 against the US dollar. And this steep depreciation is happening at a time when US tariffs are putting enormous pressure on Indian exports. Today, we will break this complex situation into understandable parts, explore what is driving the rupee's fall, the impact on businesses, ordinary citizens, and the broader economy, and most importantly, where India goes from here. This is not just about exchange rates. It's about the balance of power in global trade, the resilience of India's economy, and the political choices that will shape the future. Stay with me till the end because I promise, by the conclusion of this discussion, we'll have a clear picture of what this crisis means for India, how it ties into geopolitics, and whether there is light at the end of the tunnel. Let's begin with the headline itself. The rupee has touched an all-time low. For decades, India has experienced periodic depreciation of its currency, but this moment is unique because of the combination of global shocks, tariff wars, and domestic vulnerabilities that have come together to weaken the rupee. When the US imposes tariffs on Indian exports, it doesn't just hurt trade volumes. It weakens investor sentiment. Global investors see India as riskier. They pull money out and the rupee slides further. Why do tariffs matter so much here? Well, India is heavily dependent on exports like textiles, pharmaceuticals, IT services, engineering goods, and especially petroleum-related products. When tariffs increase, these goods lose competitiveness in the American market, which is one of India's largest trading partners. The result? Fewer exports, lower foreign exchange earnings, and more pressure on the rupee. At the same time, India's import bill remains high. Crude oil prices are elevated, and because India imports over 80% of its oil, the weaker rupee makes energy imports even more expensive. This creates a double hit. Inflation rises at home, and the current account deficit widens. Inflation is already pinching ordinary households' vegetables, cooking oil, fuel, transport costs. Everything becomes costlier when the rupee weakens. This is not just a problem for economists to debate. It's a lived reality for every Indian family. Now, let's consider the global context. The United States Federal Reserve has been tightening interest rates to fight inflation at home. That makes U.S. assets more attractive, so capital flows out of emerging markets like India and back into the United States. This phenomenon is called capital flight, and it adds downward pressure on the rupee. Combine this with geopolitical uncertainties, the Russia-Ukraine war, the ongoing tensions in the South China Sea, and unpredictable Chinese economic signals, and you have a storm of factors driving investors to safe havens like the US dollar. The Indian government has tried to respond. The Reserve Bank of India has been intervening in the foreign exchange market, selling dollars to stabilize the rupee. But this cannot continue forever. India's foreign exchange reserves, while large, are not infinite. Every time the RBI spends billions of dollars to defend the rupee, it eats into those reserves. Over time, this reduces India's ability to handle external shocks. There's another critical element here: psychology. Currency markets are not driven purely by fundamentals. They're also driven by sentiment. Once global investors start believing that the rupee is on a downward slide, they rush to pull out before losing more. That panic accelerates the fall. This is why government communication, trade diplomacy, and fiscal discipline matter so much right now. Now, let's talk about the political angle. With general elections on the horizon, the government is under pressure to shield consumers from rising prices. Tax cuts on fuel, subsidies for essentials, and measures to control food inflation are being considered. But these short-term fixes come at a cost. They widen the fiscal deficit. When the government borrows more to spend, it increases inflationary pressures, creating a vicious cycle. So what does this mean for India's standing in the global economy? On one hand, a weaker rupee can make Indian exports more competitive. For instance, software services or textile exports could become cheaper in dollar terms. But the problem is that US tariffs blunt this advantage. So instead of benefiting from a weaker rupee, India finds itself trapped. Exports don't gain momentum, imports get more expensive, and inflation bites harder. This is where geopolitics comes into play. The United States is applying tariffs as part of its larger trade strategy, aimed not just at India but at multiple countries. It's about reshaping global supply chains, bringing manufacturing back to American, and protecting American jobs. But India is caught in the crossfire. The Modi government now faces the challenge of negotiating with Washington to roll back or at least soften these tariffs. That is why ongoing India's trade talks are so crucial. Reports suggest that by November, we might see the first tranche of a trade deal. If successful, this could provide relief to exporters, boost investor confidence, and stabilize the rupee. But what if negotiations stall? Then India may need to double down on diversifying its trade partnerships with the European Union, Southeast Asia, Africa, and the Middle East. In fact, India's $680 million aid package to Mauritius, announced just this week, is part of this larger strategy to strengthen ties in the Indian Ocean region, secure trade routes, and open new markets. Ladies and gentlemen, let's pause here and think about the bigger picture. What we are witnessing is not just an economic problem. It is a test of India's resilience in a volatile world. The rupee's fall is symbolic of the larger struggle, how India navigates US tariffs, global inflation, and geopolitical rivalries. This is why the current moment is so delicate. Every policy move, every trade negotiation, every RBI intervention will shape not just the rupee, but India's entire economic trajectory. The truth likely lies somewhere in between. Yes, India's long-term growth story remains intact. But in the short term, the rupee crisis is real, painful, and destabilizing. The coming weeks will determine whether the government can strike the right balance, win concessions in trade talks, and reassure global investors. So, as we wrap up this deep dive, remember this: the rupee's fall is not just a number flashing on currency markets. It is a reflection of India's fight to secure its place in a rapidly changing world order. It's about households struggling with inflation, businesses recalculating their export strategies, and policymakers walking a tightrope between economic stability and political pressures. Stay tuned, because the story of the rupee is far from over. What happens next will affect not just India's economy, but the future of its global partnerships, its role in world trade, and the daily lives of over 1 billion people. Thank you for watching. And don't forget, what looks like a currency crisis today could, if handled wisely, become the turning point that makes India stronger tomorrow.